Okay, so it's pretty much we're on the hour. Good afternoon, good morning, or good evening, wherever you are around the globe. My name is Horst Simon. I'm the director of ADIA Lab in Abu Dhabi. I'm currently joining this conversation from Abu Dhabi, and it's my great pleasure to welcome the first team of researchers who have been selected by the readership of the Journal of Financial Data Sciences among the top 4 papers that have been published in the last year. And ADIA Lab has assembled a review team, a jury that will listen to the top 4 papers and then vote on the final for the ADIA Lab prize. The ADIA Lab prize will be, first prize will be $10,000 and then 2 $5,000 prizes. So with that, I'm welcoming Thomas Bosancic, Yuqi Ni, and John Mulvey from Princeton, or 2 of them from formerly Princeton, who will talk about regime-aware factor allocation with optimal feature solution. Please go ahead.
Very much, Horst, and thank you very much, ADIA Labs and the Journal of Financial Data Science for having us here today. I'm extremely excited to share our work on regime-aware factor allocation with optimal feature selection. So my name's Thomas Bosancic. I'll be presenting with Yuqi Ni, and we wrote this paper in conjunction with John Mulvey from Princeton University. So to begin with today, I'm going to give you a brief outline of what we'll be covering in this presentation. We'll begin by giving you some preliminary background information, starting with our motivations behind why we wrote this paper. We'll also introduce the regime identification model that we employ in this paper, being the continuous jump model. And we'll then move on to discussing the specific algorithms and data that we use in our study, discussing our feature selection algorithm, our factor data, and the actual implementation of our regime-aware factor allocation algorithm. And finally, we'll present our results and findings. We'll show you the performance of a variety of portfolio constructions, being our single factor portfolios and multi-factor portfolios, and illustrate the differences between a fixed feature selection implementation versus our dynamic feature selection algorithm. So what were our motivations behind this paper? Having been involved in the financial industry for the past few years, we all empirically know that different equity factors perform differently under different periods of time. It's no secret that different profiles of assets thrive in different environments. For example, during the period following the 2008 GFC, between 2009 and 2019, the Russell 1000 Growth Index had an average annualized return of 15.42%, largely driven by a period of low rates and secular trends in tech, whilst the Russell 1000 Value Index had an average annualized return of 10.35%, underperforming growth, as looser monetary policy and low inflation are inevitably less powerful drivers of value. So in an effort to systematize and optimize our understanding of differences in equity factor performance, we naturally turned to regime identification algorithms. So what is a regime? Put simply, in financial data science, one might classify a regime as a period of temporal persistence and homogeneity in data. When there is heterogeneity between well-defined directions of persistence, we might classify these as regimes. Now, there are a few pre-existing models that aim to perform regime identification, such as k-means clustering, the hidden Markov model, and more recently, what we utilize and add to in this paper is the continuous jump model. Now, finally, we're motivated to write this paper in an effort to address a common limitation amongst pre-existing regime detection models, being this assumption of implicit stationarity. Historically, these models have assumed that input features remain fixed in their relative importance in driving clustering. However, we know in practice, this is obviously not the case. Different input features may vary in their relative importance in driving clustering, and hence we were motivated to develop a feature selection algorithm to improve regime-aware modeling and hopefully add to this piece of literature.
So now we will go through jump model as the preliminary, as well as an example of the regime switching model class. So jump model is an unsupervised clustering method which can balance the feature classification as well as the temporal state consistency. Its objective function looks like this. So the first term is just the same as k-means clustering, which is an L2 distance between the sample point versus its centroid. But it also adds the second term, which is a constant penalization for each state transition that your st-1 is not equal to st. So from figure A and B here, we can see that by having some tolerance in the feature classification, we can actually have a much more consistent temporal state pattern. So for the k-means cluster, you can see that although spatially they are perfectly separated, however, the temporal pattern might be a mess, which is not preferred in financial regime analysis. Instead, we want it to be something like the figure B here, which is more smooth and consistent from time to time, which is very beneficial for our framework and data analysis. Besides the jump model, there's also a variant called continuous jump model. This model actually allows continuous output values rather than discrete ones. So the continuous value from 0 to 1 actually imply the probability of being in each of the states, and the objective function is also modified to adapt that. Like now, the temporal penalty will be the L2 loss from the previous state to the next state. The benefit of this is that continuous jump model can be more precise because now your output is not only a discrete label, but also you allow the model to tell you the confidence about its regime identification. Besides, this model can also be more flexible and robust since you can discretize your output labels. For example, from the figure C, you can set different thresholds based on your own application and data properties. So now, with this model, we'll go into our algorithm and data details. We'll first introduce the general framework that we use to fit the regime switching model and apply it to data analysis. It's basically a four-step process. So the step one is a model fitting. We use the historical data within a context window, say 20 years, to fix a model. Then we can fix the model parameters, which will be used in step 2 and 3. So in step 2, this is the in-sample regime identification, where we will just apply this fixed model to a context window, say 20 years on a rolling basis. This means when we train the model, we fix the weight, and for each day, you can collect the data up to today and back to the length of historical data, and you will get all the in-sample regime identification result within this historical length. However, you not only want the in-sample identification result, what you want is also the out-of-sample forecasting, which is done in step 3 here. So for each rolling window, what we can do is actually use the last regime from the in-sample period as the forecast for the next adjacent day. So this methodology is quite simple, but proven to be effective because it's based on the implicit assumption of the regime that it needs to be temporally consistent. We don't want to say that, okay, we see the asset price is going up, so it's the bull market today. Like tomorrow, it's going down, we think it's the bear market. And the next day, it's going up again, we think it's the bull market again. We don't want to do that because that's not fitting to the underlying temporal state, it's fitting to the noise. Instead, we want it to be more smooth and consistent, which can benefit our analysis and also the controlling the daily turnover. And the step 4 is that after repeating step 2 and step 3 on a rolling basis for a certain period of time, say half of a year, you may feel that, okay, now the model weight might be a little bit outdated. Then what you can do is that you can just go back to step 1. You can refit the model and update it. Then you can go through this framework again and do the regime forecasting for your data on a rolling basis.
So now let's discuss the actual data that we used in this study. For our factor data, we chose to get as close to the classical definition of equity factors as possible and used the Fama French research portfolios separated on deciles. We defined growth as the bottom decile of assets separated on book-to-market ratio, value as the top decile of assets separated on book-to-market ratio, momentum as the top decile of assets separated on momentum, quality as the top decile of assets separated on profitability, and large cap and small cap as the top and bottom decile of assets separated on size. Additionally, we use two categories of input features in an effort to capture both market-specific data and macroeconomic data using S&P 500 dividend yields, S&P 500 PE ratios, and S&P 500 prices, as well as the US 3-month interbank rate. We then performed feature engineering on this set of features by adding an exponentially weighted moving average, an exponentially weighted moving downside deviation, and over two different sets of span lists being 5 days and 21 days, a week and a month, and 21 days and 126 days, a month and 6 months.
So now we will illustrate how we add the novel feature selection algorithm into our framework. From the previous 4-step fitting framework, in step 1 fitting, we can actually now have the freedom to choose among 6 different feature sets that are listed below. So for each of the feature set, you can see from the table that we first need to include the factor return itself, since this is what we want to identify and predict. Besides that, we can also add extra features like S&P 500 related features and interest rate, and they will highlight different aspects of the market condition. So each feature set can contain both of them or just one of them. Besides, we will also choose different hyperparameters, which are different span lists. So this is an idea that's similar to the half-life of exponential smoothing average. So they can now focus on either short-term or long-term dynamics respectively. So finally, we will train the model with each feature set independently, which means here we actually train 6 different models in parallel, and we want to choose the best one among them, which means the best fixed feature set. And how we do it is that we will use the in-sample regime-aware return as the metric. Suppose that we have a two-state regime. One regime is the growth, or you can call it like the bullish regime. The other is decrease. You can also call it the bearish regime. And for the in-sample period, you can now assume that put all the money on the specific asset in bear market, in bull market, and put more the money on the risk-free asset in the bear market. By doing that, at the end of this in-sample period, you can calculate how much profit you get at the end. And this actually indicates how well your feature set works for the in-sample period. You can basically choose the best feature set for that period and assume it will be fixed for the next few rolling windows until your model is retrained and updated again. So this way, you can dynamically select the best feature set work for different market condition and time period.
So now we'll give you a breakdown of the different portfolios we construct to perform our testing. Firstly, we consider a set of single-factor regime-aware portfolios, whereby on any given day, if the regime forecast is growth, we place all holdings on the factor, and if the regime forecast is crash, we place all holdings in risk-free US 3-month Treasury bills. Secondly, we consider a multi-factor regime-aware portfolio where on any given day, we consider the factors that are in a growth regime state, and we will equally weight between them. If no factors are active, we allocate all holdings to US 3-month Treasury bills, and we rebalance daily. Finally, we construct a baseline multi-factor regime agnostic portfolio that simply equally weights to all factors with daily rebalancing. Now, before we continue, I want to emphasize that the portfolio construction element is not the key innovation of this paper. It was our goal to use a simplistic and clear portfolio construction methodology in order to demonstrate the true power of the regime identification process. We know that through further optimization of transaction costs and more complex weighting algorithms, such as a Markowitz optimization, we can massively enhance the performance of our regime-aware portfolio. However, for the purposes of illustrating the power of our regime-aware modeling, we have tried to keep things simple in this domain.
So that basically concludes our key algorithms. I will also introduce our experiment settings, including the basic assumptions and hyperparameters we use in running simulations. So first, we assume that we use a fixed transaction cost, which is 10 basis points for one-way trade and 20 basis points for the round trip. And further, we assume there's no taxation for the simplicity of clarification. Finally, we also assume that for each Fama French factor portfolio we consider here, they are just single asset, which means we don't consider the underlying component changes through the time. We want to emphasize that this is actually a more conservative consideration, since if you want to consider the underlying weight changes, the daily turnover can be even smaller than what we estimate here, and the transaction cost can be further reduced. The hyperparameters we are using are listed as below. So the data range is from 1970 to 2023, which include more than 50 years of data. Our context window is 20 years, which is the historical length. And the out-of-sample testing period starts from 1989 to 2023. We update our model biannually, so we'll basically retrain it every 6 months. Finally, for the risk-free rate, we'll use US 3 months Treasury bill.
So now we're going to move on to our results section, and we're going to start with our single factor results. And in the plots that will follow, the red shaded region indicates the crash regime. And for our single factor portfolios, we would completely reallocate to risk-free US Treasury bills in these periods. Now, as you will see across each of our single factor portfolios, the regime aware portfolio is able to successfully identify and avoid large market drawdowns during the GFC, COVID-19, and volatility during the tech bubble. This is evident as the Sharpe ratio for momentum increases from 0.19 to 0.61, for value from 0.40 to 0.69, for growth from 0.50 to 0.77, for quality from 0.48 to 0.76, from large cap 0.48 to 0.77, and for small cap from 0.48 to 0.92. Now, a key component we want to point out in these examples is what we believe to be the fundamental value of our model, which is its ability to significantly avoid market drawdowns. Over each individual factor, we can see that the model does a fantastic job at identifying a change in regime out of sample and successfully reallocates away from a factor moving into a crash regime over those 3 really large drawdown periods historically, again being GFC, tech bubble, and COVID-19.
So besides visualization, we also provide a comprehensive numerical evaluation over different metrics as shown in the table. So basically, you can see that compare the regime-aware model versus the regime-agnostic one, our model achieves a higher return, lower volatility, lower downside derivation, as well as better maximum drawdown. This means that our model can also achieve better Sortino ratio and karma ratio, where Sortino ratio is basically the average return minus the risk-free rate over the downside derivation, and karma ratio is the annual return over the maximum drawdown. So those ratios are similar to the Sharpe ratio, but they are more tailored to emphasize the downside risk. And besides, our regime-aware model also has a fairly good information ratio. And although our model will switch between like different regimes, say the active and inactive regimes, however, you can, thanks to the property of the temporal consistency of the states, we don't switch too often, and you can find it from the daily turnover that our turnover rate is fairly manageable.
So let's now move on to our multi-factor equal-weighted portfolio results, where in this plot, the blue line represents the performance of our regime-aware multi-factor equal-weighted portfolio. The orange line represents the multi-factor regime-agnostic equal-weighted portfolio, and the final line represents the S&P 500. Now, as can be seen, the performance improvement of moving to a regime-aware multi-factor portfolio is quite substantial. We can see the Sharpe ratio more than double relative to the S&P 500 from 0.48 to 1.02. We importantly see the annualized return improve from 12% to 17.45%. And to emphasize our prior point, the drawdowns are adequately averted through the use of our regime-aware modeling. We see the annualized downside deviation decrease significantly, and the maximum drawdown of our regime-aware portfolio more than halve at negative 22.17% relative to the S&P at negative 55.25%. This phenomenon can also be observed in the significant improvements in both the Kalmar and Sortino ratios.
Besides, we also want to illustrate and prove the effectiveness of our feature selection algorithm design. And the way we do it is to compare the feature selection algorithm with the fixed feature set. We choose a fairly strong baseline, which is that we fix the feature from time to time, but we will always select the best performance for each of the metrics here among all the 6 feature sets. So the results here are all presented with the equal weight multi-factor portfolio, same as the previous chart. But what you can see here is that basically our feature selection algorithm can have higher annualized return, which is 17% versus 14% for the best fixed feature. And also our feature selection algorithm can have comparable volatility, downside derivation, and maximum drawdown to the best fixed feature. So this actually means that our model achieves higher return as well as near optimal risk control, which result in finally the higher Sharpe ratio, Sortino ratio, and Kalmar ratio. So this basically proves the effectiveness of our dynamic algorithm of selecting the features.
On this slide, we present evidence that validates our initial empirical observations and hypotheses that features are not stationary. In the figure on this page, we output a tally of the number of times that each individual factor selected a particular feature set as the optimal feature set for a given window. As we can see, there is a distribution among feature sets for each factor. And put simply, there is no single feature set that adequately drives clustering over the entire temporal period for each factor. We can also see that different factors have different preferences of feature sets, further demonstrating the uniqueness of regime definitions across different equity factors. In this figure, we can see that factors such as quality and value depend more heavily on market-specific S&P 500 data, whereas momentum tends to rely more heavily on short-end rates, our proxy for macroeconomic data.
So finally, we want to summarize the 2 key contributions of the paper. The first one is that we apply the continuous jump model to factor data and illustrate its effectiveness in regime analysis, for example, in-sample regime identification and also out-of-sample regime forecasting. So this is done via our 4-step regime-aware framework. The second is that we design an optimal feature selection algorithm which dynamically assign the optimal feature for different time period based on the market condition as well as the data, which removes the assumption of implicit stationarity of the statistical jump model and the other traditional regime switching models. So that's all of our presentation today. Thank you very much for everyone listening, and feel free to raise any questions if you have. Yeah.
Thank you, Yuqi, and thank you, Thomas, for your presentation, and thank you for structuring so well and finishing it early. So I would like to turn it over, and the first set of questions are for our reviewers, and I'd like to ask the reviewers to use the raise the hand feature, and then I'll call on you to ask your question. And then after the reviewers are done with asking the questions, we will open to the general audience. So the first hand raised was a question from Alexander Antonov. Alexander, please go ahead.
Yes. Yeah, hi. Thank you for the presentation. My question is pretty simple. What did you compare your results with the different regime construction models? For example, this hidden Markov model or other things, because it's kind of natural baseline.
Oh, yeah. Thank you for the question. Yeah, I think first I want to emphasize that our framework is not limited to the jump model. Our key innovations here are two parts, like as you illustrated here. First is to apply the regime switch model on factor. It can be jump model, it can be HMM. Secondly, it can be like it's our feature selection algorithm. This can also be applied to any kind of regime switching model. The point here we use jump model is first is mainly because it's fairly robust for the financial data, like in the imbalance cases, or when your data length is when your data size is limited, and which is also proven like to be having some advantages over the HMM in our daily asset data. However, this does not mean that our model is only restricted to the jump model. But thanks very much for raising that question. And
okay,
Thomas,
so your novelty is that if you know the regimes, right, where you can avoid the drawdowns. That's the main novelty.
Like one main novelty, I think, is to say that on the factor, this regime model can work well, and we use this jump model as an example to illustrate. And second is that we can integrate a generic feature selection algorithm. This can also be applied to any regime model, like say jump model or HMM. I think there's no limitation of like applying HMM or other popular regime model to this.
And to just add one last thing, in addition to that, I suppose our sort of natural choice of using the jump model, in addition to the points Yuqi raised, is so we did start with the HMM and experimented with that. One thing that we found limited the HMM in this context just was the very frequent state transitions, which inevitably, when you start introducing transaction costs, becomes extremely expensive. And although we didn't actually display those results in this paper in comparison, it kind of was our starting place, and we moved away from that primarily for that reason, as it does seem to struggle in some cases to identify these periods of persistence and homogeneity, and does switch quite often. But thank you for your question. That's definitely a starting place where we began this.
Please do. Thank you.
Okay, thank you. Any other questions? George, please go ahead.
First of all, thank you very much for inviting me, and thank you very much for the excellent presentation. It's a very interesting topic and very close to my heart. You mentioned that your selection algorithm removes the assumption of implicit stationarity. What other assumptions do you have in order to be able to effectively remove such assumption?
I think this assumption of implicit stationarity, the degree by which you move it can be varied. I suppose in this example, we refit biannually. Of course, we actually did experiment with daily refitting. We just didn't feel that it added too much value to the model. But essentially what we're trying to remove here is the idea that a model should be confined to the same features over all periods of time. And, as we can see, maybe I can show a quick example just to illustrate.
Please.
So in this particular example, this is the momentum factor from 2018 to 2023. And this is basically showing the time series selection of a given feature set through time. So before I explain this figure a little bit more, if we go back to this is just simply showing you the distribution of what the optimal feature set decisions were over each period. So for quality and value, for all of them, you can essentially see a dispersion of choices between features. But to do this temporally, this is sort of illustrating that. Now, of course, you can try to qualitatively unpack this. For example, the switch from S&P 500 specific data to very interest rate heavy data in early 2020. One might say that is because Fed funds rate was immediately taken to zero during COVID. Maybe that was a strong driver during this period. Of course, there's different ways to interpret this, but that kind of fundamental fact that seems to be embedded in a lot of these regime models, that there is persistence and stationarity in those input features, is kind of that first assumption we wanted to break.
Yeah, I definitely agree. And one more point I want to add is maybe our current algorithm mostly focus on the feature selection, like mainly because like many previous paper they use fixed feature set with equal weight among all the features. Here, what we provide is basically a binary choice whether you include this feature or not for a certain time period. But definitely, you can make this more sophisticated. So you can tune the weight of each feature, which we think will be a very important follow-up step for this paper.
Okay, thank you.
Okay,
So
thank
next,
you very much.
Thank you.
next question comes from Kaushik Balasubramaniam. Kaushik, go ahead.
Thank you. It was a nice talk, and actually, you answered one of my questions about weighting the features. So I have a related question actually. So in principle, the span list could also vary with like regime, and also the lambda parameter in your equation, and could also vary with like you can use different lambda parameters in principle, like based on the feature. So is that something you thought about, and just wanted to get your idea on that?
Thanks for the question. For the span list, that's definitely what we want to include for different feature set, because we think like some of the span list, they are short, like weekly or monthly. They emphasize more on the shorter term patterns, while some focusing more on the longer term. So this is something we want to switch over time to time. For the NumPy, we actually choose a fixed NumPy for this study, like all the experiments are running with the same NumPy. We don't want to emphasize too much on that part because it increases the complexity and deviate from our principle of just like doing feature selection comparison. However, if you want to make a framework more sophisticated, you can definitely do more of like fine tuning on the parameters, on different parameters or different experiment settings. Here, we are not doing that. We want to just have a simple but fair comparison among all the different experiment settings and in the operation study.
So, yeah, for instance, like if you choose infinite lambda, it's essentially no regime switch because it will have one static regime that should match with your non-regime regime agnostic portfolio. So there is some dependence on lambda. I would expect some dependence on lambda, like the backtest would depend on choice of lambda. So that was the reason. So thank you.
Okay, thank you. So the next question is coming from Guido Imbens. Guido, go ahead. Guido, you're still muted.
So could you say a little bit more about how you would generalize this from the 0-1 weights, inclusion or not, to continuous weights, and what you would expect the benefits to be, or where this would actually matter?
Yeah, sure. Thank you for the question. I think that's a very interesting and thoughtful question, because we're also considering like different ways that we can do to follow up this and expand this work. For example, from the figure that Thomas shows here, you can basically see the different like different features, how they different feature set, or what's their loss function and what's their metric, like in sample cumulative return. Maybe one simple way is that you can, based on that weight, to design a continuous weighting over different features. Say that you can, based on the importance of each feature, doing like making the sum to 1, but proportionally or in some linear way to assign this weight. I guess one of the benefit is that now your allocation become more continuous, so your transition should be more smooth. It's not like a binary switching. This can reduce the daily turnover, and also potentially can increase the return and reduce the volatility on because you have like a more optimized portfolio construction. Yeah, that's some of my assumptions. So Thomas, any thought on that?
Yeah, I think that there's quite a few things that could be done to ingest that continuous data. I suppose the sort of fundamental goal through this is, do you want to do something in discrete space or continuous space to essentially help you identify what regime am I in and how do you define that regime? So I suppose if we did consider this a little bit, is maybe we want to have some sort of dynamic allocation based on the continuous number that you get out. Maybe that's quite literally a probability of existing in some regime. So I suppose for the purposes of this paper, we just chose a discretization threshold on the continuous number based on past studies, seeing that these kind of small spikes, although not necessarily large, still might be suggestive of moving regimes. So we made that threshold relatively low. But moving beyond this paper, it's absolutely something that we think could massively enhance going from the qualitative to actually implementing this even more effectively.
Yeah, sure. And one more thing I want to mention here is that we can also choose different metrics for the in-sample period, like how you choose the feature. Currently, we are using the in-sample cumulative return, but also you can see that we use the Sharpe ratio. We actually test the in-sample Sharpe, and it doesn't make a big difference there. Or you can design some customized way to measure how important each feature or each feature set is, and in that way, you can incorporate your own maybe human prior to those features.
Thanks. Yeah.
Thank you.
Okay, thank you.
Thank you for the question.
Marcus used to have his hand up, but Marcus, you have your hand down. Did your question get answered in between? If not, please go ahead and ask it.
Thank you, Horst. Thank you for this presentation. Very interesting. I was wondering whether these Sharpe ratio values would survive multiple testing adjustments. And so how have you tried to adjust for the possibility that this is a spurious result? And if you have not done so, how would you recommend to proceed?
When you say would it survive multiple model adjustments, what in particular is coming to mind as something that you think would be worth adjusting?
No, not multiple model adjustments, multiple testing adjustments. So you have run a number of back tests, and you are presenting some Sharpe ratio values. It's reasonable to expect that these are among the best results that you produced as you tried different parameter combinations and different model specifications and so on. So as a result of that, the expected value of the maximum Sharpe ratio increases as a function of the number of trials and also the variance of the Sharpe ratios that you have computed. So the question is, how can we deflate this Sharpe ratio? And have you thought about correcting these results for the fact that multiple tests have taken place?
I think that is a really good question. And we've tried to, through the pursuit of writing this paper, be as, I suppose, academically and intellectually honest in model parameter choice so that you don't have this overfitting or peak ahead bias. So I suppose that our sort of model parameter choices, for example, the jump model hyperparameter, we use consistent with prior papers. So we try not to modify that so much as to actually maximize our expected Sharpe ratio over the results. I wouldn't say that we actually conducted much fine tuning in our choice of, say, look back window or biannual fitting. So there might very well be more optimal decisions there. I don't know, Yuqi, if you have any thoughts on, adding to that.
Yeah. Yeah, sure. I think our framework from our experiment setting, or what we can see is that this is fairly robust to the parameter choice. For example, the transaction cost, we test a few, the random seed, we change a few, and if the number that we also change a few, like due to the time limit, we don't present all the study we've done. But what we see is that we actually see that the result is fairly robust. The advantage of the new novel framework, like based on the merit of dynamic feature selection, and as well as the regime-aware model and the factor data is quite clear and consistent. But if we really want to say and have a consideration that we finally want to say maximize the Sharpe ratio, like we can actually that's an extension to the studies that we can change the metric, as we may mention, like we can run multiple rounds of the experiment, change the seed, and maybe compare the randomness, like have a randomness metric for the in-sample period, which choose the feature with not only the best performance, but also like a good robustness from time to time, like with different random seed. That can be an important follow-up step if we want to make this framework more generalized to that side. But for the current study, we're trying to make it as transparent as possible. Professor Mulvey, do you have anything to add, or?
Is it appropriate for me to say something? I'm one
Yes,
of the authors.
of course. You're one of the authors, of course.
Okay, thank you. Well, of course, oversampling is always a challenge, and the only real way to do that would be to put some money on it and see how it does over time. Both Thomas and Yuqi are working in those areas, so I don't know if they've applied it or not, but in a real world environment. I think as I mentioned, this idea of trying to be as simple as possible to not to complicate the process. We've done a lot of extra work on adding different aspects to it going forward, so this doesn't stop here. And so that's always a perennial challenge. I think this is about as good as you can do given the short nature of the testing, but it is always something that's going to persist in this area, overfitting, obviously. I do want to make a point about one of the advantages. I've worked on regime-aware models for almost 2 decades, and most of the work, Hamilton or Timmerman, otherwise, is to look at economic environments. What is the economic environment that tells you when the stock market is going up or in other asset categories, bonds are doing well or not? Here we're taking different factors and trying to look at how each factor does as an independent entity. So we know growth stocks beat value stocks, in many periods. And so this gets at the idea that factors are not permanent, that they have different times of growth and crash, and you should look at each of those individually. So that's one advantage, I think, of this kind of analysis is to try to focus on a particular factor and try to try to find a way to take advantage of that over time. So that's an advantage of this kind of approach. The other thing that is limiting is the inability to go back 50 years and get sentiment. There's other kinds of data that could be put into this, obviously, and people are looking at those topics. But here we had to limit it to topics that you want to go back that long, you have to limit it to the data that's available during those periods of time. So that was another issue here, to kind of take this really long time period and try to do a test of that. And we see that there are good results even with the data of that type. So those are 2 things that I just wanted to emphasize in this analysis. Of course, we continue to work on this with the team. There's several other doctoral students on the call here, and love to get anybody's input as we proceed in this work. So
let me provide 2 suggestions. First of all, thank you for these comments. One of the answers related to robustness, which of course is very important, however, is a distinct problem from multiple testing. It is true that robustness is connected to overfitting, but is connected to in-sample overfitting. A model can be overfit on the test set and be very robust. So it's 2 different types of overfitting. So the robustness analysis is very helpful. It addresses in-sample overfitting. Keep in mind the typical example of a n-degree polynomial where n is the number of observations, right? So that relates to in-sample overfitting. For out-of-sample overfitting, it would still remain the question of how many trials have taken place. It's very helpful to know that, as you said, you have tried parsimonious models as simple as possible, not make things overly complex, etc. That helps in that it keeps small the variance of the Sharpe ratios that you have encountered through your trials. But still, we have the question of the number of trials. So my suggestion is, as you proceed with this research or you engage in new projects, it would be helpful if you preserve the evidence of all the trials that you compute, and then you can add to your paper an appendix where you disclose, we have conducted 100 backtests. This is the correlation of the returns of all trials. It leads to, let's say, a cluster correlation matrix of 6 trials. Essentially, we have conducted 6 trials. Yes, we have run 100 backtests, but it equates to essentially 6 different models. And therefore, we can correct the p-values based on this number of trials, and we can deflate the Sharpe ratio. And I think if you provide this level of disclosure, it makes the results so much more interesting in that it just addresses straight on with an empirical approach the question of how inflated the Sharpe ratio it might be. That's my suggestion.
I think that's
Thank you for the suggestions. That's very important point. I want to mention that we have like an open source code base for replicating the jump model like in the group, which include both continuous jump model that we use here and discrete jump model. We are also happy to provide the way to replicate the result presented in this paper. But that's definitely very good suggestions, and thank you for raising that concern.
Okay, thank you. We have 2 more questions, or maybe 3 more questions lined up. So, Guido, you still got your hand up? You're next, or was that still one from before?
Sorry, that was still from before.
Okay, from before. Then Alexander.
Yes, I have just a quick comment. Because recently we have issued a paper where we considered continuous regimes, continuous factors corresponding to each asset, for example. Of course, the discrete regimes can also be put there, and the main point what we have done there is that given a certain utility, you can come up with the portfolio construction weights, which will depend on these regimes or factors or whatever you call them. Such that for different utilities, you can come up with with the different analytical expressions. So as a relationship with your paper, you can analyze your utility function and assign to each weight corresponding to a factor its functional dependence on the regime. So if you're interested, I can post this reference to this paper to the chat. Just was a comment for that.
Yeah, we would love that if you could please do that. Thank you for that comment.
Will do.
Thank you. Yeah. In terms of portfolio construction and sort of assembling the different factors based on their regimes, we had quite a few ideas of how we wanted to extend this, and we were kind of grappling with that because the way in which you could even consider in the simple sense like growth and crash in this context is introducing a long and short component as a first step, since it really is identifying these drawdowns. We did make the decision in this paper not to do that, so that we didn't stray too far from the central goal. But absolutely, like we would love to read any recommendations you have to extend this going forward.
Okay, good. Thank you.
Okay, good. So Kaushik used to have your hand up and now it's down. If you still want to ask a question, please go ahead. If not, then I'd like to open up.
Sorry, I was actually muted. Sorry about that.
Okay, you're still fair. Okay, good. Go ahead, please, Kaushik.
Sorry. So part of it was actually covered by Marcos. It was actually related to multiple testing. So I was actually, I'll have a look at the paper again, but I was just curious about how the cross-validation was actually done. So I know the features were selected based on in-sample cumulative return, but was that like did you do K4 cross-validation or something while choosing your hyperparameter. That was my question.
Yeah, so our feature forecasting methodology, as explained in the 4-step process, is fairly simple. So it's basically using the in-sample regime identification result from the last day as the prediction for the next adjacent day. So for that part, it's fairly simple. So there's no further hyperparameters involved there. There are actually a few more works that try to use the in-sample regime identification result to try to forecast the future with some models, say tree or a linear regression. In that part, you may need further validation because you need to tune the weight or train another model for that. However, in our study, we want to keep it simple and effective. So I don't think we have we don't need further validation for that part. However, our framework in general, all the results are presented in the out of sample flavor, and the details are illustrated here as Thomas represents this algorithm. So yeah, so this 4-step framework, we try to keep all the things to be out of sample, and there's no further looking here. And also there's we try to minimize the thing that we can overfit or like fine tune the parameters too much.
Good. Thank you. I'll take a look at it. So I was more concerned about the lambda is a hyperparameter, for example. So it would be fixed by some cross-validation methodology. But I'll take a look at your paper. Thank you very much.
Okay, at this point, I'd like to open up to the general audience for question. Please use the same raising hand if you have a question. So free for all to ask. Okay, waiting. Going, gone. No more hands up. So then I would just like to raise my hands, and I can't find the applause button. So I'd like to thank the speakers and the team for their presentation and for being with us for almost an hour. And I'd like to thank our reviewers for also being here. And I'd like to remind you to fill out your review form and maybe wait until you've had a chance to hear the other presentations so you can compare. And I'd like to invite all of you to the next presentation, which is Monday next week, September 8th, and I believe it is at 4 p.m. Gulf Standard Time. Hopefully you can compute very quickly to what time it is in your time zone. Thank you, and then good afternoon or good morning, and have a wonderful rest of the day.
Thank you very much.
Thank you.
Bye.
Thank you.
Thank you very
Thank
much.
you so much.
Thank
you so much, our audience.
Thank you.
Thank you.
Very
Thank you,
interesting.
speakers.
Thank you.
Thank you very much.
You're welcome. Bye-bye.
Bye.
Mm-hmm.